What if I told you there's a stock that could realistically triple your money as interest rates drop? Most investors are completely missing this opportunity because they're focused on the wrong companies. Don't be one of them. Before we dive in, hit that like button and subscribe so you never miss a big investing idea like this one. The company I'm talking about today is SoFi Technologies, ticker symbol SoFi. SoFi is not your typical old-school bank. It's a modern, fast-growing financial technology company built for the mobile era. And it's positioned perfectly to benefit from falling interest rates and a new wave of consumer demand. I'm going to show you why institutions are already piling into this stock, the three major catalysts that could drive SoFi much higher, and the key numbers you need to know if you're thinking about adding it to your watch list. Let's start with what the smart money is doing. I use a tool called TradeVision to track something called dark pool data. Dark pools are private exchanges where big institutions quietly place their trades. When I typed in SoFi last week, I saw something remarkable. Almost every day, institutions were net bullish on SoFi, buying far more than they were selling. That's a whole week of steady accumulation while most retail investors weren't paying attention. When you see that kind of pattern, it usually means large funds are setting up positions ahead of a move. Why are the big players so interested? The first reason is simple: interest rate cuts. The Federal Reserve has just announced another cycle of interest rates cut. Most people think rate cuts help all banks equally, but SoFi is special. Its original business was refinancing student loans. Government student loans often cost borrowers 6% to 9% interest. Right now, SoFi can offer rates closer to 4% on average, sometimes even lower for top borrowers. When the Fed cuts rates, SoFi's cost of capital drops, which means it can offer even cheaper loans while still keeping a healthy margin. If you're sitting on a government loan at 6% and SoFi is offering 3%, the smart move is obvious. You refinance with SoFi. That drives massive loan growth for the company. And this isn't some tiny niche business. SoFi already processes around $1 billion in loans every quarter. As borrowing costs fall, demand for refinancing explodes, and SoFi is perfectly positioned to capture that surge. The second reason is SoFi's business model and cost advantage. Traditional banks rely heavily on expensive branches, large staffs, and old technology. They have thousands of locations to maintain, pay rent on, and insure. SoFi operates almost entirely through its mobile app. No costly branch network, no armies of tellers, no outdated computer systems. That means far lower overhead and a lower cost of capital. SoFi gathers deposits through its high-yield savings accounts, pays customers a competitive interest rate, currently around 3.8%, and uses that cheap capital to fund loans. Meanwhile, the average big bank still pays depositors almost nothing, often less than 0.1%. This gap is a huge competitive edge. SoFi's growth numbers prove that customers are noticing. In the most recent quarter, SoFi's revenue jumped 44% year over year, and net profit soared 159%. Deposits climbed to $30 billion, giving the company a deep pool of low-cost funding. Customer growth remains explosive, 850,000 new members in a single quarter, bringing total members to over 11.7 million, up 34% from a year ago. This is no longer a small fintech startup. It's a rapidly scaling financial platform, taking market share from the old guard every quarter. Another key metric is cross-selling. SoFi doesn't just sign up customers for a single service and stop there. Once you open a savings account, there's a 35% chance you'll use another SoFi product, like a mortgage, a personal loan, a credit card, or their investing platform. The more services a customer uses, the more revenue SoFi earns, and the stickier that customer becomes. This flywheel effect is one reason why SoFi's growth keeps accelerating even as it gets bigger. The third major catalyst is crypto and blockchain services. For a while, strict SEC rules prevented banks from offering crypto trading. Non-banks like Robinhood could do it, but SoFi couldn't. Those restrictions have now been lifted. SoFi is rolling out crypto trading again, along with advanced services like using crypto as collateral for loans and enabling international money transfers via blockchain technology. Crypto is regaining momentum, and SoFi is stepping back into the space with the advantage of an actual banking license, something most fintechs don't have. That license allows SoFi to offer services other competitors legally can't, while lowering its cost of capital even further. Now let's talk about the stock itself. SoFi just reached $29.51. When a stock clears a long-term ceiling, history shows it's statistically more likely to keep climbing than to reverse. Breakouts attract momentum traders, algorithms, and funds looking for growth. Combine that with institutional buying and a flood of positive catalysts, and you have a recipe for continued upside. Always manage your risk, of course, but this setup is powerful. Let's recap the biggest drivers for SoFi's future growth. 1. Rate cuts fuel loan growth. The US still has about $1.8 trillion in student loan debt. As rates fall, millions of borrowers will look to refinance at lower costs. SoFi wins that business because its rates are already far below government loans and will drop even further when the Fed cuts. 2. High-quality customer base. SoFi's average member earns about $136,000 a year and carries strong credit scores. These customers borrow responsibly, pay on time, and use multiple services, which drives profitability and keeps default risk low. 3. Crypto and new services. With regulatory barriers gone, SoFi can once again offer crypto trading and is planning advanced blockchain-based products. This opens up an entirely new revenue stream with huge growth potential. 4. Structural cost advantage. Operating digitally means SoFi has no costly branches, fewer employees, and lower overhead. That allows it to pay depositors more, lend at competitive rates, and still enjoy strong margins, something old-school banks can't match. Put all of this together and it's easy to see why big investors are buying while many retail traders are still asleep. Institutions are not sentimental, they follow the money. And right now, the money is pointing toward a future of lower interest rates, cheaper refinancing, and digital banking dominance, all areas where SoFi shines. Remember, timing matters. Knowing when to sell is just as important as knowing when to buy. The market rewards disciplined investors who plan their exits and control their risk. That's a lesson every serious investor should master. So what's next? Keep an eye on the Fed's future rate announcements, SoFi's earnings reports, and dark pool data for signs that institutional buying is accelerating. Watch how deposits and cross-selling metrics trend. Those numbers reveal the strength of SoFi's customer flywheel. And track crypto developments, because new blockchain services could unlock another wave of growth. If you found this breakdown helpful, make sure to like this video and subscribe so you don't miss the next big investing opportunity. Every week we cover stocks with explosive potential and break down the data so you can make smarter decisions. SoFi is proving that banking can be faster, cheaper, and more profitable when technology is at the center. With interest rates about to fall, student loan refinancing set to surge, and crypto services coming back online, the pieces are in place for a powerful move higher. The big funds see it. The data shows it. And now you know it too. Hit that like button if you learned something today, subscribe for more high-impact stock analysis, and keep watching for the next opportunity that could transform your portfolio.